Hi, I'm Katie Flynn from SavingForCollege.com. Welcome to the Financial Aid Awareness Month webcast. Thanks for joining us today. I'm very excited to introduce the moderator for today's event, CNBC's Senior Personal Finance Correspondent, Sharon Epperson. Sharon was named one of the best personal finance experts of 2014, and in addition to reporting for CNBC and CNBC Digital, she hosts CNBC's top-performing digital show, Retire Well. At the conclusion of today's event, Sharon will be announcing the winner of the Amazon Echo speaker, so stay tuned. Thank you again to Sharon and our three other panelists for helping out with this important event today. And so with that, I'll hand it over to you, Sharon, to get started.
Thanks so much, Katie. I'm glad to be here and to be talking about saving for college and paying for college with such great experts that I follow all the time to get information to tell our viewers and our listeners about what they need to know about planning for college. So welcome everybody, and welcome to Fred Armine. Fred is with the Armine College Affordability, and he also is a certified financial planner. He has a great website out there for everyone to check out called efcplus.com. Great information about figuring out your cash flow as you're trying to decide where you want to go to college or where you want your child to go to college and how you're going to pay for it. Peg Creanti is the Senior Vice President for Business Development with Ascensus College Savings, and she has been responsible for running a number of 529 plans, knows a lot about the 529 plan world. But I must say the person that I actually literally do have on speed dial on my phone is Joe Hurley, founder of SavingForCollege.com. Wonderful website with so many resources about financial aid and 529 plans, saving for college, paying for college. A great website to bookmark today if you haven't already, to make sure that you have a go-to place, just like I do, when you have a quick question about college affordability, college savings. So thank you to our panelists, and I want to open it up to Fred to kick us off with just a couple of things about how your websites work, and also, most important, what is the biggest mistake that people make? Let's start off there.
Well, thanks, Sharon. Thanks for inviting me today. It's a pleasure to be here today for everyone. Our company, we're a fee-only financial planning firm. We have a niche in the entire college funding process, from how to save for college all the way to student loan forgiveness, loan repayment. So we actually help parents understand the full-year cash flow, what the financial outcome looks like, and hopefully maximize the resources that you go through. We see, how debt is going up, the amount per student, and the total amount of defaults, and we're trying to create some financial literacy around that. The biggest issue I see that in our practice is the lack of vision for the financial outcome, how to utilize your resources the best way, and what type of debt you'll have. We often tell clients to envision their child at age 25 because more and more careers require postgraduate degrees. How do we use those resources the best way, and then what does your debt structure look like?
Yeah, Peg, I know that you're helping out families when their kids are newborns or maybe even just a thought, and family members as well, figuring out how to start saving for college at an early age. Tell us a little bit about what you do and one of the biggest challenges you think families face right now when it comes to paying for college.
Absolutely. Thank you, and again, thank you to Saving for College for including me in this panel. Before I answer your question specifically, I've been asked to just mention that, of course, my opinions are mine alone and not necessarily those of Ascensus College Savings, and nothing I should say today should be construed as any form of investment or tax advice. And, of course, we always tell people that before you invest in a 529 plan, obtain a copy of the plan's program description and read and consider it carefully before investing. We always tell our clients many state plans offer benefits specifically for their taxpayers, so please, everyone should review home state offerings first. So then, just to answer your question specifically, we think one of the challenges is because of the nature of 529s and because they're offered by states, we see that families it can be almost a paralysis, that people aren't sure that what state 529 plan they should invest in, because there's a misconception that if they invest in a particular state 529 plan, their child is going to have to go to college in that state. And certainly I know everyone in this panel understands that's really not a rule at all, that 529 plans are extremely flexible in terms of the types of institutions, the locations of institutions that future students can enroll in. So So we think that we really need to get the word out that 529 plans are extremely flexible in terms of how you can use them.
All righty. Joe Hurley, let me thank you as well for bringing us all together. And we have a lot of people who are listening right now, watching, and a lot of questions that we're going to get to momentarily. But what is the biggest issue you find that people really need to understand as they approach paying for and saving for college?
Well, thank you very much, Sharon. Yeah, I founded the website savingforcollege.com more than 15 years ago because I felt that information needed to be made available to families as well as to financial professionals about these 529 plans. There's so many of these plans out there. They're all a little bit different. Some have state tax benefits that you need to consider, as Peg mentioned. So it can be a little bit confusing. So we put together a website to provide free information. It's sort of a consumer reports for 529 plans. We do not sell 529 plans at savingforcollege.com. All we do is provide information to help people understand and take advantage of 529 plans. And probably the thing that I find is the biggest hurdle for families is just getting started, because, as I mentioned, it can be confusing. Some plans out there, you're not sure which way to go and which plan to open an account with, or even some of the rules that are associated with these plans. So my suggestion is you really do have to just jump in, get past that sense of confusion. And one of the better aspects of 529 plans is the low contribution limit. So you can open an account with just $25 in most states and have that account open and start working for you. And then you can get more comfortable, more familiar with the plans. You can change 529 plans in the future if you don't like the one that you chose initially. So there is a lot of flexibility, as Peg mentioned, but the important thing is to get started. Don't procrastinate, because college is going to be here before you know it.
All righty. Fred, I want to ask you this question. I know that Peg and Joe are the 529 plan experts, but can you explain to our viewers what you tell clients every day? Why should I even bother with a 529 plan? What is it, and why is that a better way to save for my child's education than just putting money in the bank for them?
Well, I think there's the major advantage, a big misconception is what the 529 plan and how it's structured and where it falls for financial aid. Any 529 plan within the family, which means the parent and the children, is considered a parent's asset in the financial aid calculation, which has the lowest amount, and actually there's an allowance before you even count assets. The growth potential being tax-free and the estate advantages are just really great for a 529 plan in comparison to the other opportunities you may have, and especially with some of the states offering tax benefits. I just think it's a really great place, and often overlooked or not is everyone said some of the issues with the overwhelming information. Am I doing it the right way? And Peggy said, just get started. I think probably the biggest thing too is just understanding your financial aid positioning. I heard an interesting comment today as everyone worries about that sticker price, but if you understand your EFC calculation, that actually can give you a lower goal, and which may make the 529 plans seem more attainable.
And that EFC contribution, that's your expected family contribution?
That's the expected family contribution, yeah. That's the result of you completing the FAFSA form, or there's another form called the CSS profile, which the schools use to determine if you qualify for need-based financial aid. Yeah.
All right. So let's start with kind of helping people figure out, if you're just starting out, Peg, and you're trying to figure out how to save for your child's education. Joe mentioned you can start with a very small amount. Can you start with as little as $25, $100 a month? How should you start? How should you structure it? And should you have different 529 plans if you have several children?
Yeah, that's a great question. That's a question we often get. Yeah, as Joe said, most 529 plans have initial contribution requirements of very low, in the $25 range. And where we see people have a lot of success is when they put those contributions on autopilot. Essentially, all the 529 plans offer a way to basically say, I want to contribute some modest amount, $25, $50, on some sort of regular schedule. So you could say once a month, even once a quarter. So you just get into the habit of setting aside some money for college education. And then as you get a raise or you get some sort of your financial situation changes so that you're able to contribute more, you can bump that up. But really putting that on autopilot through either automatic contributions from your bank, or also we see a lot of success with people contributing through regular payroll contributions. We see that as a real path to success. The second part of your question was, should I have multiple 529 plans if I have multiple kids? And I would say, particularly in the direct in the direct sold, we haven't talked much about the advisor sold or direct sold, but for people who are investing in direct sold plans, most of those plans don't have account fees associated with them. So having multiple accounts for multiple children is not necessarily going to cost you any more. And because most plans have investment options that are structured around a beneficiary's age, which can be a very attractive option for families who are saving on their own and don't have an investment advisor, we see people having a lot of success with that. So opening up an account for each individual child. I will say there's tremendous flexibility with 529s in terms of if one child goes to college and one child decides not to pursue education after high school, you can take those assets and transfer them to another beneficiary, to another child, with no penalty. So, you know, we see a lot of benefits to actually opening up an account for each child and very little risk associated with that.
All right, let me go to something that you mentioned, Joe, if you could answer this, because I know you've done a lot of research on this. There are direct sold 529 plans and advisor sold 529 plans. The difference is one that is just that, direct. You just get it yourself and you can sign up for it on your state's 529 plan website. The advisor sold, you have to go through a financial advisor. What's better?
That's a great question. It really depends on your situation. As you mentioned, the direct sold plans you can open up directly on the website. Often, many times just electronically. You don't even need to fill out paperwork necessarily. And they tend to be lower cost plans than the advisor sold plans, because advisor sold plans have to charge fees in order to compensate the financial advisor. So you might think, well, everybody should be using direct sold. Well, it depends on your overall investment approach. If you use a financial advisor for your retirement savings, you know, why wouldn't you use that same financial advisor for your college savings if they are doing the right job for you? On the other hand, if you are doing investments on your own, doing your research and making your own calls as far as your own financial profile goes, then there's no need, in my opinion, to go to a financial advisor just to open a 529 plan. You're doing everything else on your own, you might as well do the 529 college plan on your own too. So I would say understand your general investment approach right now, and that to a large extent is going to dictate whether you want to go to a direct sold plan or an advisor sold plan.
All right, another issue that came up, and I want to get, Joe, I want to get your opinion on this, and Fred as well, that Peg mentioned, was that you can set it on autopilot in terms of making regular contributions either by payroll or monthly or quarterly, but you can also set it on autopilot by having the investments age-based. So based on when your child is going to go to college, the allocation within that 529 in terms of what it's invested in will become more and more conservative the closer they get to college, so you don't see the same kind of stock market volatility in the 6 months or so, say, or 2 years even before your child is going to college. That said, over the last several years, there's been a lot of controversy about how conservative these age-based plans actually become, and whether or not, particularly when we have a situation like just even the beginning of this year, a very rocky stock market situation, is that really the best place to put my money, and what do I need to be paying attention to, even if I've set my investment strategy on autopilot as well? Joe, what do you say to people who are in age-based plans? What should they know?
Well, I like the age-based plans because behind every age-based plan is a group of very skilled financial professionals determining what an appropriate asset allocation is based on the age of your child. So there's a lot of brain power that goes into making up these age-based portfolios. And as you mentioned, Sharon, they're designed to protect against volatility. So we all know that the stock market has been very volatile lately. If you have to pay a tuition bill in 3 or 4 months, do you want your money in an investment that could, go down 10, 20 points by the time that bill has to be paid? You probably don't. and the age-based plans will really protect you nicely when your child gets older and is looking to pay those bills. And when the child is young, you know, the investment analysis suggests that you're better off being in equities because they have most growth potential over time. So your account's going to be invested mostly in equities. Of course, that means it'll be more volatile, but over the longer period of time, you're probably with that equity portion of that account.
Mm-hmm. Fred, what do you think about the age-based plans?
I agree with Joe fully. I meant a lot of it's time too. The amount of expertise that the plans bring with them, and as an individual investor, are you going to be keeping track on all those different market conditions and how versed you are? I think as you go through that, as you pick those age-based plans, understanding your risk tolerance and having those options and identifying them as early as possible is also very important. And each investment has advantages and disadvantages. You just need to be aware of them and just.
Alrighty. So let me ask you this, Joe. I'm looking at a question here that has come from Jason Brown, who wants to know which 529 program has the lowest fees for clients, or which states have the lowest plans. What would you say to that?
Well, it's interesting because there's been an ongoing fee war among 529 plans in the states that run them for several years. So fees keep coming down more and more and more. And anyone who thinks that 529 plans are expensive hasn't looked at these plans in many years. They are very reasonably priced, especially if you compare it to what you might be paying in your own 401k. The fees in a 529 plan have been reduced dramatically. You can still compare 529 plans between the different states to see what their expense levels are. At savingforcollege.com, we actually do a fee study twice a year. You can get that online. It's free. And what we do is we rank the plans from lowest fee to highest fee, and we look at the most expensive options within that plan as well as the least expensive options in that plan, so you kind of get a feel for the range of expenses in those plans. And when you're looking at fees, Sharon, remember that in a 529 plan, you generally have 2, maybe 3 levels of fees. The first level of fees is the expense of the underlying investment. Many 529 plans, especially direct sold, have gone to index funds or index ETFs because those happen to be the lowest cost investments out there. So they're low cost because of that. Then there's a plan administration fee or a plan manager fee, which is the fee that's charged to actually operate the plan. Those have been reduced dramatically over the years, so those are at very low levels. And then the other fee, there might be an account fee in some plans that you might be paying $10, $15, $20 a year just to maintain the account. But as Peg said, most plans have gotten rid of those account fees, and so usually you don't have to worry too much about account fees.
All right, I have this question from Amanda that I think a lot of folks have when they put money into a 529 plan or they think about it. What if my child doesn't go to college? Or what if they decide to travel for part of their college experience or go to art school for part of their college experience? What happens to the funds in that 529 plan? Joe?
Well, Peg mentioned the flexibility of 529 plans before.
Peg, what happens if your child decides not to go to college? What should you do with that money?
You know, as I said earlier, just the flexibility in terms of the type of school. You know, we talk about 529s as college savings plans, but truly what they are is post-high school education savings plans. Because if your child wants to go and pursue a trade school, an art school, as you said, for the most part, those schools, the tuition and expenses associated with those schools are qualified expenses for a 529 plan.
What about a study abroad program? What about a study abroad program, Peg?
Yes, typically a study abroad program, you're actually paying tuition to the school, the domestic school that your child is attending, and so of course that would be considered a qualified expense. But we also hear questions around what about an international school if my child decides to go to school in Canada or another country, and there are a number of many universities, many international universities are considered qualified for 529 plans. And I don't know, Fred, I know there's a certain list that the government puts out tied to, I think their financial aid that basically provides a list for parents to know what schools are eligible. I don't know if you could speak to that.
And the list is that varies also by country, and you know, the citizenship and how they're doing their taxes is really high dependent on where it can be used and what you qualify. In most cases, if you fill out the form, the majority of the times, you know, the schools we're talking about, you will be able to use some of the 529 rules and also some of the federal loan programs.
Fred, let me ask you this question, which has also come up from our viewers, which is, how do I put the money in the 529 account, but now how do I use those funds? How do I access them and then use them to pay for college? And can I say I want the money to just go to the tuition credits but not to the housing? Or, you know, how exactly do I do that?
Well, typically it doesn't work that way. You'll typically just get a bill from the school, again, depending if they're living on campus or off campus and how you're paying that bill. That's often something that's overlooked. If you have expenses, if you're moving off campus, a lot of the large campuses, you're moving off campus, you can still use your 529 money for those expenses. But also what's very important too is working with your CPA or tax accountant, and that's an important part. With certain income brackets, the opportunity credit, which goes if you're filing married and joint, is 160, 180. And if you misuse your 529 plans, you may forfeit that $2,500 tax credit. So it's good if you talk to your accountant and do some pre-planning, your financial advisor, by paying the $4,000 first, and then the balance with the 529 plans will allow you to get that $2,500 credit. And that gets into, you know, some more sophisticated planning. But, you know, using your 529 in the best way is really absolutely important, where you can maximize the total resources you have and lowering that total cost of college.
Let me get Joe to jump in here as a tax expert as well, in terms of, you know, let's think that there are a lot of viewers out there that actually have saved a little bit. They have a little bit in their 529. They may have, you know, retirement money. They may have an emergency savings. We're talking pie in the sky that everybody has these different buckets that financial advisors are always telling them they should have in terms of savings. What do they access first? Do I access the 529 money, or do I access the money that's been put in a custodial account for my child? Do I access my Roth IRA? And then, as Fred mentioned, how do I do it in a way that ensures that I get the biggest tax breaks that I can as my child's in college?
Well, you have to look at the situation. In most cases, if you have had your 529 account for a while and it's built up some good growth and it's tax-free if you use it for college, I tend to suggest that you use your 529 plan as much as you can to cover college costs, because that money is coming out tax-free. If you use other resources and then your child goes in a different direction, then you don't need all that 529 money at the end to pay for college because your child has done something else. Then you have to make some other decisions with your 529 money. It's almost too late for it to come out tax-free for that particular child, although you do have the flexibility to redirect that to another child in the family. But I would usually say, yeah, if you have the opportunity to take out tax-free money from your 529, that's really what you should focus on first. If you have other sources, let's say you mentioned a custodial account, Sharon. Custodial accounts can really hurt from a financial aid standpoint, as Fred knows. And so maybe if financial aid is a big consideration, you really want to deplete that custodial account first. So you kind of have to weigh a few of these different factors.
All right. Very good points. Very good points there. When you're looking at a 529 plan, another question that's come up quite a bit is to how to figure out whether if you don't like your plan, how do you get out of it? And so, Peg, I wanted you to talk about some of the potential shortcomings of a 529 plan. You don't like your plan, you want to get out of it. How easy is it to transfer funds? And then just say, you know, that you don't actually access that money, or that is the biggest pot you have and you need to access it for something other than college. What is the penalty there to think about?
Yeah. It's actually quite easy to move funds from one 529 plan to another. If for whatever reason you're not satisfied with the plan that you're in, that there's a process that every plan supports that allows you to roll your money out and put it into another 529 plan. As long as you put it in within the specified time frame, as long as when that money comes out of the 529 plan, it goes into another 529 plan, that will not be considered a taxable event. And so, it's actually quite easy if for those people who have found a 529 plan that for whatever reason meets their needs more, better. And what was the second part of your question again?
I actually forgot because I have another one already. I wanted to ask you about, because I'm looking at another question which we really need to address, which the 3 things that you need to look for in a 529 plan. And we talked about the initial things that you need to look for, but you need to do a gut check, right, on your 529 plan at various stages, I would assume. So what are the things that the benchmarks that you should be looking at? Is it just returns, or what are 3 things that you tell people to look at, Peg, in terms of getting a 529 plan and then making sure that they're in the right one after they've been in it for a little while?
Well, certainly returns. You want to, and certainly returns in the context of what's going on in the market. As you said, it's been very volatile, and there are 529 plans where performance hasn't been great over the last quarter, but performance in the market's not been great. And so, really, the performance, how your plan is performing relative to your investments and relative to the overall market. That's certainly one thing. Certainly, service is something that we pay very close attention to in terms of, are we answering questions? Are we processing are transactions processed correctly? Are you getting what you need from a service perspective? And from another thing that we think is very important are some of the add-ons that we at Ascensus College Savings have kind of put into our platform to allow people to make it easier to save for college. Most 529 plans have gifting functionality, which allows friends and family to essentially easily put money into your 529 plan in lieu of, presents at the holidays or birthday. And there are very simple and easy to use tools that many plans have that allow you to kind of spread the net in terms of college savings. We also have relationships with loyalty programs that allow people to use everyday spending to help them save for college. So really some of those additional things that are outside of the core 529 plan can really make a difference in terms of your long-term savings. So those are 3 things that we tell people to look for.
That's a very good point. Fred, here's a question that I think is really good for you to answer, actually. And I'm sure a lot of people are in this situation. David says that we have not been able to save for my daughter to go to college. She is currently in her 3rd year of high school. Is there anything at all that I can do in the next year to help minimize the cost of a 4-year education in Texas state universities? So a couple questions that I would have from that is, one, is it too late if your child is in the 3rd year of high school to even think about opening up a 529 plan? And is Texas a state that offers prepaid plans? Is that something that you are in favor of, Fred?
So the first thing I would tell him to do is he has to understand his EFC or financial aid positioning and how that works together. And Joe kind of hinted it before, having assets in the child's name. Everyone thinks the EFC number is one number. It's actually 4 separate calculations. There's parents' income, parents' assets, students' income, students' assets. And you have to understand the parents' side of the equation and then the schools you're considering when you make that decision. That will determine your financial aid positioning. And that myth of taking everything out of the student's name, out of the custodial accounts, is not necessarily true, because once you know what the parent side of the equation is, that will help you create your strategy. So let me give you a quick example. Off the top of my head, I don't know what the Texas state's tuitions are, but say it was $25,000, and the parent side of the EFC calculation was $32,000, and we had assets in the child's name. It's not going to matter if we take the assets out. So that's the first thing, is understand your financial aid positioning. Then the next part would be understand your cash flow, how we're going to structure the debt, and then looking at the 529 plans. Texas doesn't have income tax, so there's no tax benefit there. You'd have to look at what state your in-state programs are. Many of the states offer in-state tuition, in-state contributions to 529 benefits, so Texas won't have that advantage. And as far as the prepaid program for Texas, off the top of my head, I'm not sure. Joe could probably answer that better. A lot of the plans have canceled and come back, and so Joe would be probably a better person off the top of my head. If Texas has a prepaid program, that would be better.
Joe, does Texas have a prepaid program, and what is your view of prepaid programs versus the traditional 529 plans?
Texas does have a prepaid program, which is a program separate and apart from the 529 savings plans that we've been talking about. Prepaid plans that some states have are also 529 plans, but totally different type of 529 plan. And
how do they work?
The Texas prepaid plans is definitely one of my favorite prepaid plans because it really works out nicely for the family that sends their child to a Texas public institution. You have to look at the rules. I'm not even sure if the Texas prepaid program would accept a student who is now a junior in high school. They do have some age cutoffs in those plans, and it might be younger than a junior in high school. I just don't recall in that particular plan. But there's about 10 other states that have prepaid tuition plans. There's also a prepaid tuition plan that's designed for private colleges. It's called the Private College Prepaid Plan. And they're, like I said, they're different. And you have to look at the pricing in the plan as compared to the potential benefit of the tuition benefits down the road. Some states have gotten a little bit out of kilter. They're charging more than they used to as compared to current tuition levels, so you have to be a little careful there. You have to be careful about the risk that the states are taking on and whether they can handle that risk within their prepaid plans. So there's some different issues. You really just have to look very carefully at the disclosure documents so that you can understand how your prepaid plan works.
Peg, are you a fan of prepaid plans? And how should someone who perhaps has the opportunity to either contribute to a prepaid plan in their state or a 529 college savings plan, how do they decide which is best for them?
Yeah, it's hard to make a general statement about, how good prepaid plans are relative to savings. I think some, as Joe said, are terrific values for families who are quite certain that their child is going to attend that in-state university. I mean, one of the things about prepaid plans is most of them have, and most if not all, have a state requirement, a state residency requirement, so they're really much more restrictive in terms of their usage than a regular savings plan. So they're a little more restrictive in terms of eligibility, and then there are different rules for using them. So I would say, as Joe said, everyone is different, and you really need to look closely and make sure that it's going to meet your needs that could be 15 years down the road.
All right, I want to switch gears for a moment as we've talked about how to save for college, and now talk a little bit more about how to pay for college. The government has about $150 billion in aid money that is available to individuals, but a lot of folks don't know how to access it. And so I think we've talked about it, but not specifically exactly how you go through it. And one of the first steps, Fred, is to fill out that federal application, that free application rather, for federal student aid, that FAFSA form. Why is that so important, and why is that kind of the gateway to everything else when it comes to financial aid?
I would agree. Everyone should complete the FAFSA form, no matter what your financial position is. Life is full of changes, and it'll be the first thing if something does change in your financial life, the financial aid officer will request. That drives, for most of the schools in the country, except for about 250 schools, the primary positioning number that they will use to determine if you qualify for need-based aid. And we use a strategy for our clients that we recommend, even if you're not going to qualify for need-based aid, to take the Stafford loans in a lot of cases. And even as an example, Bill Gates, if he filled out a FAFSA form, his children will still qualify for a direct student loan or Stafford loan. It's a progressive amount. It is a little complicated in the sense there's a subsidized and unsubsidized, but that amount of money is legally in the student's name. They have better loan repayment rates, and the interest rate's lower. So that would be the first part, and if you don't complete the FAFSA form, you don't get access to that. If you're,
no matter what your income, Fred, I just want to be clear, no matter what your income, you can qualify for the Stafford loan.
Yep. If you fill out that FAFSA form and submit it, now there's a new change this year. Every family will have to create what's called the FSA ID. It replaced the PIN number. You used to have a 4-digit PIN number. That's something new this year. So some new parents that maybe last year filled out the FAFSA form had a PIN number, and they may have had it for a few years. They will now have to establish what's called this FSA ID. That is basically your legal signature to the document. Your student will also need that to sign that that form. That then generates your EFC calculation or number, and the schools then use its cost of attendance minus that EFC calculation number is what you now qualify for need-based aid.
Yep, your expected. So it's your cost of attendance minus the expected family contribution, and then the amount that's left is what?
Is what you qualify for need-based aid. And the unique thing on the federal side, and we'll just focus there, that will be the same number at every school. So if I'm looking at a high-end school that's say $50,000 or $60,000, and my EFC number is say $32,000, I'm going to qualify for aid at that school. Now I look at maybe a state school, an in-state school, and their tuition is $28,000. I'll still qualify for aid. It won't be need-based aid, but you still will qualify even though your number's above that. It will be the same number at all schools on the federal methodology.
All right. There's a question that's come up a couple of times, Peg and Joe, about whether or not I need to fill out the FAFSA if I have a 529 plan. What's your answer, Peg?
Yeah, I think those two are really very, they're not related. I think that listening to Fred, it makes sense for almost every family to fill out a FAFSA form, and 529 is just a piece of information that you'll need to supply. So I would say yes. And Joe, I don't know what your thoughts are on it.
Well, one thought I have is to remember that financial aid does not mean free money in most cases. The majority of federal financial aid is loans that eventually has to be paid back. If you qualify for need-based aid, those loans can be subsidized to some extent by the government, so they can be very good loan deals, but it's not free money. Scholarships and grants are free money, and so you need to be sure that if you're able to take advantage of those, that's where it really helps your pocketbook quite a lot. So remember, loans have to be repaid. Also remember that the financial aid rules are apt to change over time, and if your child is 3 or 4 years old right now, you should not be worrying too much about financial aid, because by the time your child reaches 17 or 18, I think the financial aid system is going to look a lot different than it does right now. Start looking at your financial aid situation when your child gets to generally high school. I know Fred might have a different idea on that, but that's when you really have to start paying attention to positioning your assets and positioning your income. 529 plans really are a good asset to have for financial aid purposes because, as Fred mentioned earlier, they're assessed on their value at a very low rate. And when you take the money out of the 529 plan tax-free, it's not counted as income to be reported on the FAFSA. And income can hurt your financial aid chances much more than assets can. If, on the other hand, you took money out of your IRA, let's say, to pay for college, that distribution is going to have to be reported on as income, not necessarily on your income tax return, but on your FAFSA application on the following year, and that can hurt a lot, even though you thought you were taking the right step by using your IRA.
All right.
Hey, Sharon, can I just jump in there 1 second?
Please do.
One big thing that both Joe and Peg that I see in our practice is the misunderstanding of how 529s need to be reported on a FAFSA form. You have to include the entire families, so that would include if you have beneficiaries of 1 or 2 children, the entire amount of only the family needs to be reported. So if I have $10,000 in 2 accounts for the FAFSA, I report $20,000. For grandparent 529 plans that are not part of, they could be, family related, but they are not part that needs to be submitted. So if a grandparent has $30,000 in a 529 plan, that amount on the federal methodology does not have to be reported, but the total for the family has to be reported.
Fred, that's a perfect segue, because the question that I have next from Dorothy is, she wants to know about transferring her granddaughter's account, 529 account, to their parent, to the granddaughter's parent, because she's getting old and it's hard to manage. So what happens, I've heard this situation with colleagues as well, a grandparent has an account or passes away and has that account, a 529 plan for a grandchild. What then happens to that money? How does a grandparent make sure that the money gets to the child and does not negatively impact their financial aid chances?
Well, so from a financial aid standpoint, I would tell her not to do that, because it may, depending on the amount of money that's there, from a federal calculation standpoint, it would not be assessed. she's better off waiting, and if she passes away, to make sure she has the documentation completed the best way and have the co-owner or the not co-owner, the contingent owner identified as whatever parent or child it's going to go to the right way, and that way it goes through the estate process the best way. All those type of things would work to their advantage. I know it could be overwhelming for her. That is stressful from a personal standpoint, but from a pure financial aid standpoint, it'd be better off if she kept the money where it was and just make sure the paperwork's in the right order.
Mm-hmm. Yeah, and on many, I would just add that on many 529 systems, certainly on our system, you have the ability to add what we call interested parties on that account. So in that situation, she could add maybe the future student's parent as an interested party. Then they get their quarterly statements, they get communications from the plan, so they're kept up to date with everything that's going on the account, and maybe some of that administrative burden can be lifted.
Okay. Here's another question that I find interesting, and I think a lot of folks are facing that now. This parent, Joni, has financial aid debt herself, and so she asked, how could that impact her child's application for financial aid? Fred?
The debt issue, so really becomes, how much debt does she have and what that's going to hurt for her in cash flow. From a pure, assuming that the parent has stayed current with her loans, I'm just going to make that assumption. The debt is really not factored in the financial aid process at all, which is kind of, that's probably the downside. It should have no impact on her in the EFC calculation. It'll just make sure that the stay current, because if she's in default, it will make it difficult for her to get any additional loans through the federal government.
What happens, Joe, in a case of divorce with a 529 plan? The 529 plan is in one owner's name, right, and one beneficiary's name. So in the case of divorce, it shouldn't really have that much of an issue. That has come up as well as a question.
Well, that's a great question, and it's sort of the Wild West out there right now. It hasn't been around long enough to see a lot of these cases come through where one parent has opened the 529 plan in their name, they get divorced, and the other parent wants to make some sort of claim on those assets or doesn't feel it's going to be used properly. So it's an issue that you really probably should think about when you open up the account. As you mentioned, Sharon, most plans require that you only can have one account owner. Some plans actually offer joint ownership, but most do not. But then if you get divorced, in the best case, you're going to use that money to pay for the child's college education, and it's not an issue. But there have been a few cases that have come up. In my state of New York, there have been a couple of interesting cases. I'm sure around the country there have been some, and there's not necessarily any consistency in the courts from one state to the other as far as how they might treat 529 plans in such a dispute. So I don't know, Peg, maybe you've seen more instances of these cases coming up.
Well, I mean, we see it from the back office, from the administrative standpoint, and like you say, it's a legal issue. So we have to, abide by any court orders and get all the proper documentation. But we really are, somewhat at the mercy of the legal system to know what to do with those assets.
All right, Fred, let me ask you this question.
Chime in there a little bit too.
Yeah, I wanted to go ahead.
Just with that, it's important when they do the EFC calculation where the tax person is going to claim the student and how that's going to impact. So in the divorce, who the owner was, that also needs to be considered when you mix up or where that asset sits and how much it will be, because the FAFSA will only require one parent to submit based on their tax filing. So that's
okay, so I think you're answering this question I'm going to ask you. You just kind of answered it, but if you could kind of walk us through again how this works, because Lisa's concerned. She wants to know if parents divorced, whose income is listed when applying, and does it matter if the non-custodial parent is claiming the child on taxes?
So in the past year, we've moved, or the last 2 years or 3 years, it's moved to what's called the data retrieval tool. So the FAFSA system and the IRS system are now linked through what's called the data retrieval tool. It has always been our recommendation, whichever parent is going to claim the child out on the FAFSA form should also be the parent that submits the claims them on their IRS forms. That's our general rule. We follow that from the very beginning. I just think it's the simplest. We've heard some horror stories. Now with this retrieval tool, they'll bring in the other parents' information where it could hurt them. And what parents have to understand is when you go through this process in a divorce situation, the schools, as a part of their admission process, and this is the business aspect of it, look at your ability to pay. So when we have divorce situations of clients, we actually have a conversation. Hopefully they're talking to each other where we can now measure what their financial aid position is going to be and explain to them if we have a loan, get more money, but it may be harder for them to get into the schools they want to, versus if they higher income family, their ability to pay is much more attractive. They'll probably have a better chance to get in some of the more competitive schools if that child's borderline to begin with. So you really have to understand both sides of the equation and make a conscious decision.
Gotcha. There's a question here. We've talked a lot about 529 plans, of course, but there's a question that I think came from Eloy about a Roth IRA, Joe. And can you use a Roth IRA to pay for college, and how do you go about doing that?
Well, you definitely can use a Roth IRA to pay for college, because the contributions that you put into your Roth IRA you can take out at any time for any reason without taxes or penalty. You're basically just taking out your original contributions to use for another purpose. So there's a lot of flexibility with a Roth IRA in being used to pay for college. The potential downside, and this is a surprise to families who actually get caught in this, is when you take that distribution from your Roth IRA, even though it's not reported on your income tax returns, it does have to be reported as income on your FAFSA returns. There's kind of a 2-year delay in that process of reporting income now, but that can hurt you quite substantially. So you thought you were doing the right thing by using the Roth IRA for college, and that can come back to bite you quite severely. The other reason not to use a Roth IRA for college is because it's just a great retirement savings tool. So you've got the money in your Roth IRA invested potentially tax-free when used in retirement. So let it ride as long as you can in that vehicle, and not use it for college if you can avoid it.
Gotcha. We talked about prepaid tuition plans, Peg, but I want to answer this question more specifically from Ranveer, who asks, with cost of education going up every single year, what is the likelihood that I can lock in on the current tuition fee for my children who will attend their undergraduate courses after 10 years from 2016? So by 2026, when his children are in college, is there a way to lock in the tuition, and is that what a prepaid plan will do for you?
I think that's typically the concept of a prepaid plan, is that you're essentially purchasing, for many prepaid plans, you're essentially purchasing future education at today's prices, and they give you a contract, and basically it can be like a car payment where you're locked into a contract where you're prepaying for that college education, and theoretically, 15 years from now, that education could be much more expensive if you look historically at what's happened to tuition inflation, and so thereby, saving yourself potentially some substantial money. That's the concept of a prepaid plan. Again, I don't know where this person lives, but there's a very limited number of prepaid plans, and you have to live. Typically, you have to live in the state that prepaid plan is sponsored by in order to take advantage of that. So I would encourage him to go to Joe's website and see if his state offers it.
Yeah, let me jump in there too, because the Texas plan we talked about before, that is a plan where you lock in tomorrow's tuition at today's prices. Most prepaid plans, you're not paying today's prices to get into the plan. They're actually charging a premium over today's prices, and they have to do that to be actuarially sound as an investment plan. In some cases, those premiums are as much as 30, 40, 50% above today's tuition prices. So yes, you are locking in future tuition, but at a cost that might be higher than today's tuition prices. So you really do have to look at that aspect. If your child's very young and tuition keeps going up dramatically, then it's still probably a great deal. If your child's older, you don't have very much time to make up for that premium that you're paying through tuition increases in that state. So it's a more difficult proposition, I think, for older children to get into those prepaid plans.
Gotcha. Fred, I have a quick question for you that's not quick, but maybe you can at least reiterate your websites that people can go to for information on this. Roberta asks about consolidating options for parents who find themselves burdened with student loan debt. Where do they go?
They really need to be careful about the student loan debt and how they structured it. It's really hard. There's been some new companies that are offering some loan consolidations on the private side. The federal programs, if they are federal Parent Plus loans, have some additional benefits such as disability and death benefits for both the student and for the parent. So it's hard to walk away from that. The rates on the Parent Plus loans are a little more expensive than current market rates, so that's why these private companies do exist, and you need to just really evaluate what those benefits are to staying with the federal program versus walking away. You probably could get a lower rate on some of those private programs, but also the federal program does have one parent income-based process that you could use, which most of the private sides do not.
All right, I have a question here that I think is a good way to wrap things up in the last couple of minutes that we have, where this person, Jane, has asked about naming 5 things. I'll ask you to just name one that parents of 9th graders should know about financial planning for college. Peg, I'll start with you. What do you think a parent of a 9th grader needs to know or do right now as they're planning for college financial aid or not getting financial aid for their kids?
Well, I'll focus on saving. I think a parent of a 9th grader still has maybe 4.5 years before that first tuition bill comes due, and I would say use every opportunity that you can where you might have a little extra money to sock it away, and we think a 529 plan is a great place to put it. We also really encourage people. I mean, college now is on the horizon for friends and family. People start talking about it. What are you thinking? And there are many people who want to contribute. And so we would say look to your 529 plan and look for gifting options to have people help you out with this. What is a big financial burden for most families.
Excellent. Joe, what would you say for a 9th grader, their parents? What would you tell them to do right now?
Well, I think it's important to realize that schools these days are competing very vigorously to get the best students into those colleges. And so if you can take your 9th grader and make that individual an attractive prospect to colleges, they're going to throw all sorts of money at you to try to get your child to go to that college. So participation in clubs, in the community, anything that you can put on your resume that suggests to the college that your student is special can go a long ways and can get you a lot of money in reducing the cost of college. And at 9th grade, I think that's where you really have to start getting into that and encouraging your child special.
Fred?
I think the biggest part now is the EFC calculation. We had a change as of October of this year called prior, which means that the tax years and school years don't match up. So the second semester freshman, first semester sophomore academic year is the last best tax year to look at your financial aid positions that won't hurt you. Once that student turns that second semester sophomore year tax year, any financial decisions you make will then affect your financial aid, even though it's 2 years away. That's the term called prior that went effective this year.
All right, very good advice from all of you. I think the last thing that I would say is that it's a family effort to get your child through college. And so, as Joe mentioned, making sure your child understands that they are special and to find out the things that they can do that can really make them stand out for colleges is very important, but also helping them understand how much it really costs your family to send this child through college and how they can contribute as well, I think is very important because it really is a family affair. We have excellent experts today who have joined us. Peg Creanti, thank you so much. Fred Armine, thank you so much, and Joe Hurley, thank you for hosting this on savingforcollege.com. And I urge you all to continue to have the conversation with your families and with experts and access all of the websites that we've told you about on this webinar. They can all be very helpful to you. Thank you all.
Thanks, Sharon.
Oh, I have one thing to mention. Wait, because there's one lucky winner who actually participated in this and gets something out of it. I mean, you all got something out of it, right? You got great information. But Dorothy Woodcock is the winner of the Amazon Echo. after this webinar today. So congratulations to Dorothy. Thanks, everybody.
Thank you.
Thank you.
Thank you.